This chapter 3 contains a review and evaluation of skeptics' arguments against the use of hedging instruments. In some sense, this chapter is the one that explains why this entire module is needed in the first place. After all, we appear to have shown convincingly in chapters 1 and 2 that situations often arise in which the use of hedging instruments undoubtedly adds value to an institution's business model and prospects. So, on what basis might one question the benefits of hedging? This chapter examines the principal arguments of the skeptics, which carry some validity in some cases. Our belief is that listening to the skeptics and taking their arguments seriously enables end users of derivatives to avoid excessive use of hedging tools and to devise strategies that are more efficient for the entity and more additive to stakeholder value, provided it is clear what it is that these tools are intended to achieve and what they are not intended to achieve. We start by listing the skeptics' arguments in summary fashion before addressing each one in turn. Argument 1. Hedging has a zero NPV before the dealer's profit margin. When this margin is taken into account, the NPV to the user becomes negative. 2. Hedging strips out exposures the entity's owners would prefer to keep, since these are often exposures the entity has a competitive advantage managing, and are often the reason the shareholders have selected this entity for investment. 3. Hedging at the individual entity's level is often pointless, since many exposures neutralize one another at the shareholder portfolio level. 4. Many world-famous and highly successful companies use minimal hedging tools, if any. 5. Many of a company's exposures naturally offset each other, so there is no need to hedge them individually. 6. Hedging utilizes scarce credit lines with bank counterparties, which the company is better off using to obtain liquidity. And finally, 7. Implementing a hedging program involves complex legal, accounting, and operational issues. We turn first to the argument that hedging has a net present value of zero before the dealer's profit margin, and that when this margin is taken into account, the NPV to the user becomes negative. We certainly do not expect dealers to offer derivatives to their clients at a loss to themselves. But nor would we expect insurance companies to offer insurance coverage at a loss to their institution. If hedging succeeds in reducing the risk of default and permits an increase in leverage versus the use of more expensive shareholder equity, then in aggregate the strategy may in fact increase the company's cash flows, earnings, net worth, and return on equity in many instances, despite the negative NPV of the instrument itself at inception. The difference lies between an individual derivative contract whose NPV at inception is usually negative for the end user versus the aggregate impact of the hedging program, whose effect on leverage, cost of debt, and possibly price-earnings multiple could certainly be positive. In the first case study in Chapter 1 involving the bank, it would be difficult to deny that the entry into the FX forwards had a negative NPV in itself at inception, given the dealer's need to earn its profit. But we demonstrated that the FX forwards reduced the bank's capital requirement by half, in essence permitting the replacement of $20 of expensive common equity with $20 of much cheaper deposits. There is no definitive cost, quote-unquote, to common equity, but typical models for the cost of capital, of equity capital, assume at a minimum a cost of not less than 10% when rates on money market instruments such as bank deposits are around 4%, as in the case. So by replacing the equity in question with deposits, the bank saves around 6% on $20 annually, i.e. around $1.2. This is to be contrasted with the dealer's profit margin on the FX forward, whose notionals were 106 euros and dollars, requiring that the dealer's profit margin on the FX forward be around 112 basis points to wipe out the end user's savings of 1.2. It is almost inconceivable that the dealer bank could make anything approaching this kind of profit margin on a simple euro-dollar FX forward, whose profit margins, especially for solid counterparties and for short tenors, are often in mere basis points. In any event, we return to the insurance analogy and point out that the multi-billion-dollar property and casualty insurance industry, and several others, would not exist if users of insurance focused solely on the NPV of their insurance contracts. The decision to obtain coverage despite the negative NPV of those contracts is justified by contemplating the numerous other costs to the business from an uninsured loss, such as from business interruption, employee morale, and similar perspectives. In the long enough term, undoubtedly the purchaser of insurance could obtain funding or shareholder equity to replace the damaged asset and resume normal operations, possibly at a cheaper cost than via simple reimbursement from the insurance company when the insurance company's profit is taken into account. But this alternative route might require substantial delays and investment of resources and bring about serious disruption to the entity's business for a lengthy period of time. We address next the claim that hedging strips out exposures the entity's owners would prefer to keep, since these are often exposures over which management has a competitive advantage, and are often the reason the shareholders have selected this entity for investment in the first place. A classical illustration of this argument arises with commodity producers. Consider a gold producer that hedged out the price of gold in the past several years, or an oil producer that hedged away crude prices during the same period. These entities would look pretty silly selling gold at $400 an ounce or crude at $50 a barrel, or so the argument goes. A number of responses need examination here. For one, there is a difference between hedging out exposures for which the entity has no competitive advantage versus those for which it does. The gold producer that decides to remain fully exposed to gold prices should still take seriously the need to hedge FX, interest rates, and even its exposure to commodities other than gold, as to which it cannot legitimately claim to enjoy any competitive advantage. And even if it believes that in the long run its shareholders expect it to maintain a long exposure to gold prices, i.e., not to hedge away the upside potential of gold price increases, a strategy of hedging for the short term or during periods of substantial uncertainty as to the direction of prices could still make sense as a buffer against unexpected price declines. Addressing specifically the argument that shareholders purchase the company's shares to achieve a long exposure to gold prices, we would point out first that more efficient ways abound for achieving such exposures with futures, exchange-traded funds, and numerous other tools. Using the gold company to go long gold brings with it exposure to the skills of management, its operating efficiency, and numerous other drivers of value which may or may not be desired as well. Some shareholders presumably are convinced that the company's processes and managerial approach are solid and generate for the company an acceptable margin from the extraction and refining process, with or without the benefits of additional price upside. The investor who seeks both might be better satisfied with an investment in a specific gold producer whose hedged margins the investor finds attractive, along with a long position in gold futures or call options to reap cheaply the upside potential of the commodity in itself. Indeed, at one point in 2011, the newspapers contained articles on the narrowing margins of some gold companies that were occurring even as the price of the metal was soaring, due to an increase in operating costs that exceeded the increase in the price of the metal itself. The third argument of the skeptics is that hedging at the individual entities level is often pointless, since many exposures neutralize one another at the shareholder portfolio level. To some degree, this is irrefutable. A large, diversified portfolio of shares might end up including shares of oil producers who have sold crude forward and shares of airlines who have bought crude forward. The net impact of a strengthening or weakening crude oil price may well be neutral for these entities' cash flows in aggregate, and the use of forwards in both directions has simply transferred wealth from the two companies to the arranging dealers without increasing, indeed all while decreasing, the combined entities' cash flows and hence shareholder value in aggregate. Offsetting this plausible argument are the following considerations. First, the individual entity normally has no way of knowing if its shareholders are indeed diversified in the manner suggested. In smaller emerging markets in particular, investment restrictions may well force investors to remain principally exposed to the shares of domestic entities, many of whom are often concentrated in a handful of industries, as to which the alleged diversification benefits at the shareholder portfolio level are simply not achievable. Second, we restate the case we made in discussing the case study in Chapter 1. Despite the negative NPV of the individual transaction, the entity as a whole may achieve benefits with a far larger positive NPV when other factors are taken into account. In the case of the bank, in that case study, the replacement of expensive equity with cheap debt. To see this in the best possible way, consider an investor who's able to purchase shares in two banks rather than just one, located respectively in the USA and the Eurozone, assuming of course the Eurozone still exists by the time you are watching this video. Assume further that the bank located in the Eurozone has a business model identical to the bank in the USA, but with its funding exclusively in euro. The European bank faces the same dilemma as the US bank, but in reverse. Should it hedge out its exposure to the US dollar on its US dollar loan portfolio, or should it rely instead on additional equity capital and avoid FX hedging altogether? The two banks, in principle, could decide to avoid hedging, on the basis that by doing so they would be entering into offsetting FX forwards that in aggregate simply dissipate shareholder value at the investor's portfolio level without producing any increase in aggregate cash flow. But then each bank would find itself with the additional 20 units of equity capital, producing in each case the diluted return on equity for their investors of 14%. Conversely, if both banks went ahead and hedged with forwards in the manner discussed in Chapter 1, they would, in each case, generate a 24% return on equity for the shareholder, ignoring only the dissipation of the dealer margin of a few basis points on the forwards. Furthermore, the argument assumes the company's management owes a duty only to shareholders and can ignore completely the interests of creditors, employees, and commercial and financial counterparties. This is not the place to enter this hotly debated area of corporate governance. But we point out that the luxury of ignoring all other counterparties simply does not arise in reality, even if it is legally permissible. Counterparties and creditors who perceive a company to be managing its operations solely for the shareholders' benefit will soon shy away from further dealings with it, or will transact with it only on less advantageous terms, such as by increasing the interest rate they charge on loans or demanding greater amounts of collateral on derivatives. In any event, and as a final argument, is it realistic to expect the company's employees to walk away from a hedging strategy that can genuinely increase the company's survival chances, and hence the longevity of their employment contract, merely on the argument that at the shareholder portfolio level, unhedged positions offset one another? It is of no use or consolation to the airline employee to hear that the misery of his new status among the unemployed is offset by the windfall gain the shareholder is reaping on his investment in one of the oil majors. The fourth argument of the skeptics is quite simply that many world-famous and highly successful companies use minimal hedging tools, if any. To this argument, little really can be said. Some of these non-users may simply happen to have few exposures that are not somehow mitigated in one manner or another. Others may just not have done their homework to determine if hedging could enhance their enterprise value or benefit them in some other way. And still others may simply have opted for the use of greater shareholder equity on the basis that their cost of equity happens to be unusually favorable at this present time, a luxury that would not extend to the great majority of smaller and less profitable entities. To the skeptics, one can reply that for every company that has never used a derivative, there exists another, or possibly a dozen others, who do so with great regularity. After all, the market for over-the-counter derivatives alone, as of today, early 2012, exceeds the $700 trillion threshold. So even if only a small fraction of these represent genuine end users, rather than speculators or market makers, we could be looking here at several dozen trillion of notional volume for end users. We do not see much value in the further pursuit of this particular argument. Many institutions issue convertible bonds while others have never done so, often under essentially identical financial circumstances. In the same way, many companies avoid derivatives while others adore them. The fifth argument is that a company's financial exposures often naturally offset one another, so there is no need to hedge them individually. We would certainly agree that a company is well advised to measure and manage its aggregate exposures across all divisions and jurisdictions before developing its hedging strategy, in order to reap maximum benefit from offsetting exposures and those for which a natural hedge might exist already. Examples include the following. Separate offices or branches might be simultaneously going long and short the same currency, in which case there really would be no point hedging either office at all, assuming no differences exist from a tax or similar perspective. Companies with receivables in a variety of currencies could find the purchase of a basket FX option cheaper than individual options on each relevant currency. This is not an argument against hedging, but rather one in favor of choosing the best hedging instruments. Companies in cyclical industries often find their revenues and margins to increase when the economy is strong, which is also when rates have a tendency to rise. Such companies are often better off with a larger percentage of floating rate debt than others in less cyclical industries. In a sense, the anticipated increase in revenues and margins when rates are high is a natural hedge for the company and serves to reduce the percentage of total debt that the company should consider fixing. This specific instance is perhaps an argument against hedging, but not because hedging adds no value for the company generally, but rather because the benefits of hedging as a device that reduces uncertainty is already available to the company through the natural cyclicality we have described. Argument 6 is that hedging utilizes scarce credit lines with bank counterparties which the company is better off using to obtain funding. Depending on the business model of the bank and the specific condition of the company, this argument may have some validity. In part, it depends on whether the bank aggregates all credit exposures towards a company and is indifferent as to whether the credit exposure arises from liquidity provision or from derivatives transactions. In some cases, separate limits are available for each, and unused lines under one facility may not be transferred over to the other, which nullifies the argument's validity. We point out also that in many instances, banks are prepared to deduct the amount of derivative counterparty exposure from the measurement of their aggregate exposure to that counterparty if this exposure is properly collateralized, and that the collateral in some cases may be shared between the credit facility and the derivatives book to diminish liquidity stresses on the company. More importantly, we argued in our 2 case studies earlier that a properly structured hedging program is likely to enhance the credit quality of the user and diminish his risk of default. This should increase his lender's appetite to provide him with liquidity rather than diminish it. It is true that our gold mine would tap into some of its available credit lines if it hedged FX, interest rates, and gold prices with forwards, as suggested in the case discussion. But it is also true that the gold mine would find its default probability diminishing from more than 5% to close to 0 by hedging, which can only work wonders for its popularity among lenders. The final argument of the skeptics is that the implementation of a hedge program involves complex legal and accounting issues. Indeed it does. The guidelines for derivatives accounting under both IFRS and US GAAP are quite possibly the longest and most complex of all. They continue to change rapidly, and new guidelines continue to be released as new fact patterns arise and product innovations reach the market. All we can say in this respect is that the accounting treatment for simpler derivatives is far more user-friendly than for complex exotics, and also that even for complex instruments, financial controllers all over the world have been able to ride the learning curve in due course, following an investment of time and resources that is typically well worth the benefits in most instances. One path many large multinationals have taken has been quite simply to forego hedge accounting altogether and accept the vagaries of having the hedging instrument marked to market right through the income statement in each reporting period. This is not to say that they view the derivative as a speculative tool. They simply find the difficulties of meeting the very strict criteria for hedge accounting to be too much trouble, and the consequences of opting out of hedge accounting something they can accept. This path is perhaps easier to take for large companies with a variety of hedged exposures that provide some internal offsets and diversification than for more modest enterprises with only 1 or 2 principal exposures. By the same token, the ISDA Master Agreement and its related supplements and appendices are opaque and tedious, and often raise issues for which few answers exist under the law particularly under the legal systems of many emerging markets. It helps a little that the governing law of an ISDA master agreement is invariably that of England or New York. But even then, a number of considerations continue to require interpretations under domestic law, particularly with regard to issues arising in a bankruptcy and/or involving any pledged margin or collateral. As with the accounting difficulties, we would point out that lawyers all over the world have been able to ride the learning curve competently, and that the investment of time and resources has typically proven well worth the benefits in most instances. This completes this chapter 3 and part 1 of this module on the benefits of hedging.